Hello, this is Shadi, and tonight we would like to talk to you about two new rules in lending industry. One is called ability to repay, and another one is qualified mortgage. Under ability to repay, the most important thing is just make sure that all the borrower's document it's been collected in the right manners, and make sure that everything is in file for lender's verification. Also is the debt to income ratio is very important, that make sure that all the liabilities of the borrower, such as their mortgage payment, their car payment, their utilities, credit card payment, all of that calculated versus their monthly income, which this is something that we always did in the past anyways. And another thing is that the underwriters under the new ability to repay are instructed to qualify the borrowers based on their highest mortgage payment, meaning that if they are borrowers with the teaser rate and the low or minimum payment for a few months, the underwriter cannot use that monthly payment to come into debt to income ratio. They have to use the highest monthly payment on that particular loan program. And then under the qualified mortgages, there are some caps and some numbers that, for instance, the maximum debt to income ratio allowed under the new QM is 43%. That it used to be 45 all the way to 55%, but we still have some lenders that they would go up to 45%. So give me a call for that. Then under qualified mortgage, they don't want to take any loans anymore with the risky features, such as any amortization term more than 30 years. There is no more interest-only options available. There is no more minimum payment, available. Meaning, so all the risky features have to be out. Then there is another 3% cap on how much the loan officers or a mortgage originator can charge the borrowers, including title insurance fee, origination fee, and a point fee, meaning that point that it's paid to buy their interest rate lower. They're all included in that 3% cap, which is 3% of the actual loan amount, of the particular loan amount. Also then there is another thing, is called steering is not allowed under QM, which meaning that no loan officers or originator cannot steer the borrowers towards the higher interest rate that they cannot afford in order for them to get a little bit of a more incentive. Then basically that's about it. And there is they want to keep all the surprises away. They want to make sure that all the loans that has been done, it does not end up into the bad bucket. And the good thing about this whole thing, that it really did not make a life hard, but didn't touch it. It was the credit score and the minimum down payment. Under new QM and ATR, there is no minimum down payment or maximum down payment rules. You still can put 5% down. You can put 10%, 20%, whatever down. And also there is no limit on the credit score, which makes the life much easier for lenders to really help out all the borrowers, especially a new, first-time home buyers. But at this time, since all the loans eventually is being sold to Fannie and Freddie, Fannie Mae and Freddie Mac are saying that we are not buying any loans that has been given to borrowers with the credit score under 620. So that we should keep it in mind. Otherwise, the rest of the credit score rules is still the same, and down payment still the same. But there are so many other niches that we have in loan for self-employed people, for people that they cannot verify their income, We still have some loan programs for those borrowers. And if you need to know a little bit more in detail about this new rules and regulations, or maybe our niche product, please give me a call at 949-510-1955. And I'll talk to you guys soon. Bye-bye now.